Welcome to the Property Wealth Podcast. Today, we're diving into a really fascinating topic: hotel conversions to multifamily properties. Opportunity or risk?
Yeah, it's a really interesting space right now, and there's so much to unpack. We've seen a lot of hotels struggling post-pandemic, right? And that opens up a unique chance for investors.
Exactly. It's like, on one hand, you have this potential for a great investment, but then you also have to consider the challenges that come along with it.
Totally. There's a lot to think about, from understanding the market demand to navigating zoning laws. It can feel overwhelming, but with the right approach, it can be really rewarding.
And we'll be discussing the key factors to consider, the costs involved, and maybe some success stories to inspire our listeners.
Plus, we'll touch on the common pitfalls that investors might face so they can avoid those mistakes and really maximize their investments.
Absolutely. So whether you're just curious about the idea or seriously considering jumping into this niche, stick around as we break it down.
Let's get into it. So, when we talk about hotel conversions to multifamily, it really hits home for those of us over 40, right?
Absolutely, Mike. A lot of listeners are thinking about their retirement timelines and how they can secure their financial future.
Exactly. With inflation being a real concern lately, many folks are looking for ways to protect their wealth. Real estate has historically been a hedge against inflation, and converting hotels can be a smart move in this market.
Right, and it's not just about the investment side of things, it's also about emotional security. I think many people over 40 are feeling that pressure to ensure they can provide for their families and leave a legacy.
Yeah, totally. I've worked with investors who've shared stories about the emotional weight of wanting to pass down something meaningful to their kids. One couple I know, let's call them the Parkers, were feeling uncertain about their retirement savings. They decided to invest in a hotel conversion project, and now they're not only generating rental income, but also creating a family asset that can be passed down.
That's a great point. So it's not just about the numbers on a spreadsheet. It's about building something that can last. And with the current economic trends, we're seeing a shift in demand for housing. More people are looking for affordable living options, especially in urban areas where hotels might be underperforming.
Spot on. In cities where tourism has taken a hit, many hotels have struggled to stay afloat. But by converting those spaces into multifamily units, you're not only revitalizing the area, but also meeting a pressing housing need.
And that can be a win-win situation. I've heard of developers who've taken over older hotels and transformed them into beautiful apartments. They're not just creating homes, they're also enhancing the community.
Exactly. And for investors, this strategy can really align with the goal of long-term wealth building. You're not just riding the market waves, you're creating a stabilizing asset. Plus, multifamily units tend to have a more consistent demand, which can be comforting for those looking at retirement.
Right, it's about creating that cash flow that can support you in retirement, isn't it? I remember talking to an investor named Lisa, who, after converting a small hotel, found that the steady rental income allowed her to ease into retirement without the stress of fluctuating stock markets.
That's a perfect example. And let's not forget about the current trends in wealth transfer. Many of our listeners are looking at how to pass on their assets to their children or grandchildren. And having real estate in the mix can provide stability for the next generation.
Yes! Real estate can be a solid foundation for building generational wealth. And multifamily properties, especially those from hotel conversions, can provide a more affordable option for young families or individuals starting out, which is so important in today's economy.
Definitely. And with the current interest rates, it's a good time for savvy investors to look at this strategy. They can lock in favorable financing options for these projects. It's not just about buying low. It's about the potential for high returns through smart renovations and effective management.
So what about the risk side of things? It can sound a bit daunting to take on a hotel conversion project. How do people navigate that?
Well, like any investment, there are risks involved. But with thorough research and a solid business plan, you can mitigate those risks. For example, I advise investors to evaluate the local market carefully, understand the demand for housing in that area, the demographics, and even future development plans.
That makes sense. And I suppose connecting with local real estate professionals can help too. They can provide insights that a newcomer might not be aware of.
Absolutely. Networking with contractors, property managers, and even other investors can be invaluable. And, of course, understanding the zoning laws and what's required for converting a hotel to multifamily is crucial.
Right, and I think a lot of people might be surprised by how flexible some of these spaces can be. I mean, you can often find hotels with large rooms or suites that can easily be reconfigured into several apartments.
Exactly. And that's where the creativity comes in. I've seen some really innovative designs that not only maximize space, but also enhance the living experience. It's about creating a community feel, which is so appealing in today's housing market.
So to sum it up, hotel conversions to multifamily not only offer potential financial returns, but also align with the emotional needs of creating stability and security for ourselves and our families.
Right. It's about looking forward and making informed decisions that can lead to long-term benefits.
And now that we've laid the groundwork for why this strategy matters, let's dive into some core strategies for making hotel conversions successful.
So when we talk about hotel conversions, a good starting point is understanding the numbers behind the investment. I mean, the financials are everything, right?
Absolutely. And one of the simplest ways to evaluate a potential property is the 1% rule.
Right. The 1% rule suggests that the monthly rental income should be at least 1% of the purchase price. So if you're looking at a property that costs, let's say, $300,000, you should aim for at least $3,000 in monthly rent.
That's a great benchmark. And it's particularly useful in markets where you're not as familiar with the rental rates. But, it's not the only number to consider, right?
Exactly. You also want to look at the 50% rule, which is another handy guideline. It states that about 50% of your rental income will go towards operating expenses. So if you're getting that $3,000 a month, you should budget around $500 for expenses.
That makes sense. And then you can start to see how much you're really netting, which is crucial. So with that $3,000 rent, you'd have $500 in expenses, and what's left is your cash flow before financing costs.
Right, you need to factor in your mortgage payments too. Let's say your mortgage is $200 a month. That would leave you with $300 in cash flow, which isn't bad, but it also might not be what you're hoping for.
Yeah, and cash flow is just one piece of the puzzle. You also want to consider the property's cap rate, which is a measure of the property's yield.
Exactly. The cap rate is calculated by taking the net operating income and dividing it by the property's purchase price. So if your net operating income is, say, $18,000 a year on that $300,000 property, your cap rate would be 6%.
That's a solid cap rate. I mean, anything above 5% is usually considered good, right?
Yeah, and it really depends on the market you're in. In some areas, you might want to aim for higher cap rates, while in others, lower rates could be acceptable if the appreciation potential is strong.
So it's all about balancing those numbers with the market context.
Definitely. And don't forget about your financing options. If you're converting a hotel, you might have various financing routes available, like traditional mortgages, commercial loans, or even hard money loans.
Right, and each of those comes with its own pros and cons. Hard money loans, for instance, can get you cash quickly, but the interest rates are usually pretty high, right?
Exactly. They can be a good option for short-term funding, but you really want to have a clear exit strategy in place.
And that's key when you're evaluating properties, too. You should have a checklist to guide your assessment.
For sure. Start with the property's location, condition, and zoning regulations.
And don't forget the potential for renovations. What's the layout like? Can you create more units?
Absolutely. The more units you can create, the better your cash flow. If a hotel has a mix of suites and standard rooms, think about how you can convert those into individual apartments or studios.
And you want to consider the local rental market, too. Are there enough demand and rental rates to support your new units?
Right. You wouldn't want to convert a hotel in a market where there's already an oversupply of rental units.
That's a great point. And while we're on the topic of evaluating properties, what about the type of hotel?
Good question. Not all hotels are created equal when it comes to conversions. Boutique hotels might have more character and charm, but they can also be more complicated to convert than standard chain hotels.
Yeah, and then there's the age of the building to consider, right? Older buildings might require more work to bring them up to code, which can eat into your budget.
Exactly. You might find yourself facing unexpected costs if the plumbing or electrical systems need a complete overhaul.
So it's essential to have a thorough inspection done before you commit to a purchase.
Definitely. And once you've narrowed down your options, run the numbers again to ensure the property meets your financial goals.
Right, and keep an eye on the cash flow projections over the long term.
It's really about being realistic and not just getting caught up in the excitement of the potential returns.
Exactly. And as we dive deeper into this, let's talk about some common pitfalls people often face when considering hotel conversions.
Oh, there are definitely a few. One big one is underestimating the renovation costs.
Yes, that can derail your entire project if you're not careful.
And then there's the timeline. People often think renovations will go faster than they actually do, which can affect your cash flow.
Right, and not having a clear exit strategy can lead to problems down the road too.
Absolutely. You really need to have a solid plan, not just for the renovation, but also for how you'll manage the property once it's converted.
So, with all this in mind, it's clear that while hotel conversions can offer great opportunities, they come with their own set of challenges.
Yes, and that's why thorough research and planning are crucial before diving in. So, one of the most common pitfalls I see in hotel conversions to multifamily is over-leveraging.
Right, that makes sense. It's tempting to want to maximize your investment, but...
Exactly. When investors take on too much debt, thinking they can ride the wave of potential profit, they often end up drowning in it instead. I had a client, for instance, who bought a distressed hotel in a promising area. They thought they could convert it into luxury apartments, but they over-leveraged.
Oh no! What happened?
Well, they were counting on high-end rents to cover their mortgage, but the market didn't support those rental rates. They ended up with a property that was cash flow negative.
That's tough. So what should investors do to avoid that?
A solid rule of thumb is to stick to a conservative loan-to-value ratio. It gives you a buffer in case things don't go as planned, And always factor in your cash flow projections before jumping in.
Speaking of cash flow, I imagine ignoring it can lead to big problems too.
Yeah, absolutely. I've seen investors focus too much on the potential appreciation of the property while neglecting the cash flow aspect. There was this one investor I worked with who bought a hotel with the expectation that they could renovate it and double the rents in a year. But the renovations took longer than expected, and they weren't accounting for the carrying costs during that time.
Oh wow, that must have been a stressful situation for them.
For sure. They ended up in a cash crunch, unable to cover their mortgage payments and maintenance costs. It's crucial to have a cash flow plan that includes contingencies.
Right, so they should build in a cushion for unexpected costs.
Exactly. And that leads me to another common mistake. Bad tenant selection.
Oh yeah, that can really bite you.
Definitely. When converting hotels, you might attract a different tenant demographic than you're used to. I had a client who didn't vet their tenants properly. They were just excited to fill the units quickly.
And?
Well, it turned out that a few of them were, let's say, not the best fit. They caused damage to the property and created issues with other tenants, which led to increased turnover and additional costs.
Yikes, that must have been a nightmare.
It really was. So a good tip is to have a thorough tenant screening process in place. Checking rental history, income verification, and even personal references can save a lot of headaches down the road.
That makes total sense. You wouldn't want to rush that process just to fill a vacancy.
Exactly. And while we're on the topic of risks, let's talk about timing the market.
Oh, that can be a dangerous game.
It really can. I once worked with an investor who bought a hotel conversion right at the peak of the market, thinking they'd ride the appreciation wave. But when the market corrected...
They were stuck, right?
Exactly. They couldn't sell for a profit, and their cash flow was tight because they were depending on short-term rentals, which dropped significantly during the downturn.
So what's the takeaway here?
Timing the market is tricky. It's always better to focus on the fundamentals of the property and the location rather than trying to time your purchase.
Got it. And then there's the hidden costs.
Ah, yes. Those can sneak up on you. Many investors underestimate renovation costs or fail to account for ongoing maintenance and property management fees.
Do you have an example of that?
Sure. I once consulted for an investor who thought they could convert a historic hotel into apartments with a minimal budget. They didn't factor in the need for new plumbing and electrical systems, or the costs of bringing the building up to code.
I can only imagine how that turned out.
It was a disaster. They ended up spending way more than they planned, which cut deeply into their profit margins.
So how can investors spot these red flags early on?
Well, I always recommend doing thorough due diligence. Inspect the property inside and out, get multiple quotes for renovations, and always build in a contingency fund for unexpected costs.
Sounds like a solid plan.
And don't forget to consult with professionals. Architects, contractors, and property managers can provide insights that you might not consider.
Definitely. So if someone finds themselves in a tough spot because of these pitfalls, what can they do?
The first step is to take a deep breath and assess the situation. You can often renegotiate terms with lenders or look for ways to cut costs.
That's good advice.
And if cash flow is an issue, consider short-term rental options while you stabilize the property. It can help offset some costs.
Smart thinking.
Lastly, always stay flexible. Real estate is dynamic, and being open to adjusting your strategy can make a huge difference.
Absolutely. Adaptability is key.
And remember, every mistake is a learning opportunity. It's about how you respond and grow from those experiences.
Well said, Mike. That's encouraging for anyone who might feel overwhelmed.
Yeah, real estate can be rewarding, but it's a journey, you know?
Totally. So let's move on to the next steps and some actionable strategies for our listeners.
All right, so let's dive into some immediate steps that anyone can take if they're interested in hotel conversions to multifamily properties.
Yeah, I think that's super important. You know, it can feel overwhelming, but starting small really makes a difference.
Absolutely. So first off, I recommend doing some research on your local market. Get familiar with platforms like Zillow or your local MLS. Just start browsing. You'd be surprised at what you can find, right?
Right. And when you find a property that looks interesting, use tools like the BiggerPockets calculator or Deal Check to run the numbers. They can help you assess the potential profitability of a conversion.
Definitely. And don't underestimate Rentometer. It's a great tool to check rental prices in your area. You want to know what you can realistically charge for rent once you make those conversions.
Yes, and if you're feeling really motivated, try analyzing one deal per week. Just pick something, any property, and run the numbers. It's a great way to build your skills without the pressure of making a purchase right away.
That's a smart approach. And speaking of skills, joining local meetups or real estate investment groups can really help. You get to network, share experiences, and even find potential partners.
Oh, for sure. And don't forget about online communities, like forums on BiggerPockets. They're full of people sharing their journeys, challenges, and successes.
Exactly. Plus, if you're looking for some educational resources, there are a bunch of books and podcasts out there. One book I often recommend is The Book on Rental Property Investing by Brandon Turner. It's a solid read.
Great suggestion. And for podcasts, I'd say check out BiggerPockets podcast. They have so many guest speakers sharing their real-world experiences. It's really inspiring.
Right? And you might even want to consider following local real estate influencers on social media. They often share tips, market trends, and opportunities that might not make it to the mainstream.
That's a good idea. Staying informed about the market is key. And, you know, even if you're just taking small steps, it all adds up over time.
Absolutely. And another habit to consider is setting aside a bit of time each week to educate yourself, whether that's reading, listening to podcasts, or studying a specific property type.
Yeah, and remember, it's okay to start where you are. Even if you can only dedicate a few hours a week, it's still valuable.
Exactly. And don't rush the process. Take your time to understand the intricacies of hotel conversions. They can be complex, but with the right tools and knowledge, you can navigate them successfully.
For sure. And if you come across a property that piques your interest, don't hesitate to reach out to local experts or mentors. They can provide invaluable insights and help you avoid common pitfalls.
That's a great point. Also, consider developing a checklist for each property you evaluate. It can include things like location, potential renovation costs, zoning regulations, and projected cash flow.
That's smart. A checklist can really help streamline your analysis and keep you organized.
And don't forget about the importance of due diligence. Always verify all the information you gather. Talk to local authorities about zoning laws and any restrictions that may apply to hotel conversions.
Right, and if you can, visit some existing multifamily properties that have undergone similar conversions. You'll gain first-hand insight into what worked and what didn't.
Great idea. And if you're up for it, maybe even tour a few hotels that are currently on the market as potential conversions. It gives you a tangible sense of what you might be dealing with.
Definitely. And once you've gathered all this information, you'll start feeling more confident in your decisions. It's all about building that knowledge base.
Exactly. And remember, the market is always changing. Regularly revisiting your strategies and tools will keep you ahead of the game.
Yes. So with these tools in your pocket, you're ready to move forward. Let's recap what we've covered today.
Wow. Sarah, what a deep dive we just had into hotel conversions to multifamily properties. You know, it really highlighted a few key takeaways for me.
Absolutely, Mike. I think one of the biggest points was the potential for value-add opportunities. I mean, transforming an underperforming hotel into multifamily units can yield significant returns.
Right, and then there's the market demand factor. With so many people looking for rental options, especially in urban areas, it's clear that multifamily housing is in high demand.
And let's not forget the importance of doing thorough due diligence. It's crucial to understand the local regulations and zoning laws that can really make or break your investment.
For sure, and I think we also touched on the risk factor. While the potential rewards are enticing, there are definitely risks involved, especially with financing and renovation costs.
Exactly. It's about balancing those risks with potential rewards, you know? When done right, hotel conversions can be an exciting opportunity for investors looking to diversify their portfolios.
So true. And at the end of the day, building wealth through real estate is really about finding those unique opportunities and being willing to take calculated risks.
Yes! And remember, it's never too late to start investing. Even if you're over 40, you can still create a robust portfolio that can support you in the future.
Definitely. So, if something in this episode resonated with you, we'd love for you to like, subscribe, and share your biggest takeaway or a question in the comments.
And if you know someone over 40 who's interested in property investing, share this episode with them. Let's spread the knowledge.
Next time, we'll be diving into ground lease investing. It's such an interesting passive long-term play.
I can't wait. Thanks for joining us today, everyone.
Yeah, thank you.
Until next time, take care and happy investing.